5:30, Tuesday the 13th. Press and public are duly notified of our meeting. First item on our agenda, or second item I guess, is the first reading by title only of Ordinance 2013-09, an ordinance authorizing the issuance and sale of a taxable general obligation funding bond series 2013 or such other appropriate series designation of the City of Isle of Palm, South Carolina, in the principal amount not to exceed $1.5 million, fixing the form and details of the bond, authorizing the city administrator or her lawful authorized designee to determine certain matters related to the bond, and providing for the payment of the bond and the deposition of the proceeds thereof in other matters relating thereto. So I'll make that as a motion for first reading. So moved. Do I have a second? Second. Any discussion on this? We have an attorney with us from McNair Law Firm. He's hiding over here. Just Brian Foley's with us. Jimmy?
Just so the public understand, this is refinancing of the marina debt, and would it be the same terms as far as the life of the loan, but we're just looking for a better interest rate?
That's absolutely correct.
And if we can acquire a better interest rate with no prepayment penalty, that would be the optimum that we're looking for here, right?
We will bid it both ways,
right,
and see what whether or not which is the better deal, and then we'll make a decision based on that.
And the life of the loan is how many years?
It'll go till 2019, which is the existing term of the current bond.
Mr. Mayor.
This is a taxable bond. We converted to a taxable for the marina back a few years ago.
And not only the interest rate, but we're looking at all the costs on top of it.
Well, yeah, it has to be a net benefit to the city. Right. Interest rate net of all the costs. These lawyers, where is he over there? The lawyers cost a lot of money. And this process is well served, but we'll do it right. But the net is a benefit to the city. And relative to the remaining interest, they're a fairly substantial amount. The
lawyers don't do it pro bono.
Not for this.
Well, I was going to retort and ask, would realtors sell property? But I'm not going to go there.
Point taken.
Can we move this along, please? All right.
Mr. Mayor.
Any other questions?
My understanding is that there's potential savings of $80,000 of interest costs over the life. Is that correct?
That is the current projection. If the bids come in as within the range of what we've expected, so we'll have $80,000 interest savings over the remaining years. All right. Any other discussion? Keep looking over here, thinking.
Yeah.
All in favor, please say aye.
Aye.
Any opposed? None heard? Motion carries. Thank you. Brian, this is probably the quickest meeting you've had today. Thank you very much. All right, next item on our agenda is we have consideration of a recommendation from the City Employee Grievance Committee. And you have in your package a recommendation from the Grievance Committee supported by the City Administrator. Do I have a motion to accept the recommendation?
So moved.
Second.
Motion and seconded. Any discussion? Not heard. All in favor, please say aye.
Aye.
Any opposed? All right, motion carries. There's no need to go into executive session that I know of. Is that correct?
That's correct.
So we'll call this 5:30 meeting adjourned at 5:34, and we'll reconvene at 6 o'clock and get about the business of worrying about flood insurance. Thank you all. Thank you all for coming. If we don't get started, I know we'll never finish. Last but not least, you're up here. This chair is wired. For those who are just visiting from other islands, I'm Dick Cronin, Mayor of Isle of Palms here. I'd like to welcome you here. We're having a special meeting, City Council, both of Isle of Palms and the town of Sullivan's Island. This is the first in my experience, and I'd like to welcome you all here. It's glad we can get together as a group, but unfortunately this is a subject that's going to be eye-opening to all of us at least. Hopefully we can do a more gentle subject at a future date. I want to thank the Recreation Department who's helped organize this Frankly, I didn't know we could get this many people in this room without a dance floor, but thank you, Will, and Norman Jean's around here somewhere. When we started hearing about this, I think Sandy was the first one to bring it to our attention, and Jimmy Ward had a shockwave go through his house, and so that brought us all here together to understand what's happening to the flood insurance and the flood insurance industry and what's going on. Linda and her initiative got in touch with Bill Silcox to help us understand all of this. He begged out, where did he go anyhow? There he is. And is going to introduce some experts that will walk us through what's about to happen to us with the Biggert Waters Flood Reform Act of 2012, which will be eye-opening to all of us. But before we start, a lot is going to be presented on the screen. Unfortunately, some of the seating here is not conducive for good viewing. So anybody who would like to just pick up your chair, move it out here in the front, it's not going to be a bother for any of us, but we want you all to be able to get a good view, and we hope that you can do that. All right, Betty, you can be right in front. we can see over your head.
Yes.
Okay. While you're organizing yourselves, we had a meeting prior to this, and that's why we set the meeting up as it was, and now we're moving to Plan B and meeting at 6 o'clock. So, all right, is everybody settled or reasonably settled?
Oh, yeah, we're fine. Yeah, good.
I'm going to turn the festivities over to Bill, who's going to walk us through who's presenting and a little bit of what's going to happen. I would suspect a lot of people are going to have questions. I would hope we could get through the entire presentation and then open it up for questioning. So make notes, if you can, of what you're thinking of. If it's early in the presentation, make a note, because you may not remember it by the time they're finished. But hopefully we'll get through this in the better part of an hour. So, Bill, it's all yours.
Volume okay? Can you hear? Mayor Cronin, Mayor Purpose, Linda, Andy, council members, appreciate y'all taking time out of y'all's schedule. As stated, I'm Bill Silcox. I'm in charge of operations at City of Reynolds County. I've also got my father, Billy Silcox, with us, who's in charge of production. Mike's affiliate is somewhere around here. He's in sales with us.
Where is it? Mike.
The agency has got over 4,000 flood policies. So obviously flood insurance is important to us. It's important to y'all, as y'all live on a barrier island. You don't want to take your pick. And some of you, like myself, were probably here for hurricane. So you know how important flood insurance is. Linda and I were talking a little while back, and we were trying to figure out the most effective way to communicate to y'all what's happened and what is going to happen with the flood insurance. We figured the best thing was just get an expert to come in here, somebody who deals with NFIP and FEMA on a regular basis. So I called our regional sales manager, whatever Estelle Jackson is, and she was instrumental in getting Patty and Rashop to come in to speak to us today. Patty is the Principal Flood Coordinator and Vice President of Quality and Training with Wright Flood. They're one of our largest writers of flood insurance in the agency. Patty is extremely busy, so I do appreciate Patty taking time to come. Let's see, she came down from Virginia and stuff came up the floor. We actually had a meeting this morning in Mount Pleasant, similar, basically same presentation, but to some realtors. Probably had about 100 of them there, and I asked Patty what her schedule was this afternoon, and she had a conference call at 1, a conference call at 1:30, and a conference call at 3, and all of them. So she's very, very busy. Patty's job responsibilities include that she is Right Flood's liaison with the National Flood Insurance Program on rules and regulations. She works with the Chief Operations Officer and Vice President of Operations on compliance with the FIP. Patty is also a committee member of the Insurance Institute of Business and Home Safety, where she currently holds the position of Vice Chair. Patty is on the Right Your Own Coalition and the FIP Conference Committee. So you will find Patty is well versed in floods, so I'm going to let her explain the issues that we're facing today.
Welcome.
Everyone. Tonight what I want to talk about is Biggert Waters. And typically I talk to insurance agents. So I'm going to try not to use slang and things like that. So just kind of give me like what is she saying, and I'll realize I'm speaking another language here. So tonight I just kind of want to go over this Biggert Waters flood insurance reform bill that was passed. As some of you may know, this bill was passed July 6th, signed by the President. One good thing out of this bill is that it reauthorized the flood program for 5 years. Prior to that, the last 2 years it was lapsing, and then homes couldn't be sold because they had to have flood insurance. So it was holding up a lot of things. So they'd be, it would be, held off, then reauthorized for 30 days, and then expired, and then reauthorized for 6 months. So the one good thing came out of this was that it's reauthorized for 5 years. There's a lot of talk up on the Hill about the flood program, about this Biggert Waters bill. We see a lot of information in the media about it, and it becomes very confusing to a lot of people. There's different sections of the bill and how FEMA is going to implement these bills or these sections. It's very important that it is, as it's signed by the President, it is law. And so FEMA, fortunately, has to enact these provisions of the bill. So what's happening first? They looked at it and they said, okay, we have to enact Section 205 of the Flood Insurance Reform Bill. And we're going to talk about that. And that deals with pre-firm homes. Now, when I say pre-firm, I mean these buildings were constructed prior to the community joining the NFIP, when there were no rules or regulations on how to build in floodplain areas. So these buildings are actually subsidized by the government. These rates, I should say, are subsidized by the government. So Congress wants FEMA to stop with all of the subsidies, gradually phase out these subsidies. So the first one they enacted was the single-family dwellings that are not the primary residence of the named insured. So in doing that, NFIP's definition of not your primary residence is that you don't live there 80% of the calendar year. If you don't live there 80% of the calendar year, they consider that a secondary home and not your primary residence. So also, what they'll be enacting in October is Section 212. And that is, now they're going to be adding what we call a reserve fund. And I'll get more into that. And then lastly, what I want to talk about is what is hitting the media right now. What we see all the time regarding the flood bill is Section 207 when we talk about map changes. So when we talk about, again, the purpose of Biggert Waters, a large section of it, was to get rid of subsidies for pre-firm properties that are not the primary residence of the named insured. So, effective October 1st, the NFIP will no longer provide any extension of premium rate subsidy to certain pre-firm policies. These properties will be subject to full risk rating, or what they call actuarial rates. These properties will require an elevation certificate, including photos, in order to determine the full risk rating for the current flood insurance rate at the current flood zone and base flood that property is located in. They will allow tentative or provisional rates for the first year. That just means, with an elevation certificate, these tentative provisional rates are very expensive as well. We just don't have the underwriting information to properly rate them. So who will this affect? So if you have a flood policy prior and have continued having the continuous coverage, if that policy was initially purchased before July 6th of 2012, these policies that are renewing on or after January 1st of 2013, this year, they start a 25% rate increase in their premium. They will continue to see that 25% rate increase annually until full risk rates are achieved. So it's not 4 years, it could be 5 years, it could be 7 years. So you really don't know when that actual date is until you get an elevation certificate. FEMA has very, or I should say NFIP has very strict rules on how we can apply elevation information. So I suggest if you get an elevation certificate now, we will automatically, with these types of properties, look at is the 25% increase cheaper or is the elevation certificate cheaper? And we'll look at it each year. So we're going to rate it either the 25% increase or we're going to start using that elevation certificate information to stop that annual 25% rate increase. So that any non-primary residence, another key, it has to be in what we call a special flood hazard area. Any flood zone that begins with the letter A or B. A is ravine-type flooding, rising water. B zones is your velocity, wave action type of flooding. So that is just strictly single-family dwellings, this effect, that is not the primary residence. Now this also, they're phasing in October of this year, non-primary non-residential buildings. So any commercial style building. Or say you have a home and you have the house, but you have a detached garage or a detached barn, and you have a separate policy on that building is considered non-residential. So they too, that would have that 25% annual increase until full risk rates are achieved, meaning an elevation certificate is needed to determine the rates, the actuarial rates. That's what they call, that's the first part of section 205 of the Biggert Waters bill, in getting rid of subsidies.
Patty, before you go on, can we have copies of this presentation?
Actually, I'm going to email copies of Bill, and Bill can get you a copy of
Okay, so if you want, we'll put a sign-up sheet over here. If you'd like to get copies, just give us your name and email address, and so you don't have to take copious notes.
No problem. So now with renewal policies, with new business, so the policy was purchased on or after July 6th of 2012, whether it was you assumed somebody else's policy, but it was a newly purchased, those policies at the very next renewal will require an elevation certificate to be rated immediately. They don't have that phase-in. They automatically would have to be rated at full risk rates. So NFIP has given us a directive and us a form letter to send out to all policyholders who bought a brand new flood policy on or after July 6th of 2012. Letting them know, we let them know 90 days before their renewal that to renew their policy on or after October 1st, we have to have an elevation certificate. We cannot offer a renewal. Again, that's going to be pre-firm buildings only in special flood hazard areas. And that's all types of buildings. It's single family, whether it's your primary or not. It's 2 to 4 family, like duplexes, other residential, like condominium associations or apartment buildings. So it's going to, and all non-residential buildings. So NFIP provides us a letter, we send it out 90 days in advance of the renewal, letting you know, get an elevation certificate. For us to offer you a renewal, we have to have that to send you a renewal bill based on actuarial rates. So, and then if we don't receive anything within 70 days prior to expiration, then we send out a non-renewal notice. Yes, sir.
Many of us have elevation certificates from years past. Are those still valid?
I will get to that, talk about the elevation certificate. Okay. So, renewal policies, as I mentioned earlier, they actually, if you don't have that elevation certificate, they can be tentatively rated. But we have to have, again, that renewal application. We want to make sure, or I should say NFIP wants to make sure you understand what happens if you choose to have tentative rates. Tentative rates means we don't have a full actuarial information to offer renewal. They are high. They can be as high as $11 for $100 worth of coverage. It's very expensive. But the problem comes in is if you purchase a tentative rated policy, and say your policy begins today, August 13th. Say on the 15th there's a flooding event. Now you purchase, say, $200,000 worth of coverage. For us to be able to settle your claim, we would have to have an elevation certificate to settle the claim. And once we get that elevation certificate, and we apply actuarial rates, if you owe more money than what you were charged with the tentative rates, we have to reduce your coverage to match the pay. So here you are thinking you bought a $200,000 policy for your building, you provide us the elevation certificate, and say you owe us owe the NFIP another $500, and we have to reduce the coverage down to say maybe $150,000, and that's the max that you can receive. I don't like tentative rated policies. If you get an elevation to us before a claim, we can automatically adjust the premium so that doesn't happen. But a letter does go to the insured, the agent, as well as a mortgagee that lets them know that this is how a claim will be handled if they choose tentative rated policy. Now, lapse policies. When Congress wrote this up, they said, okay, with lapse policies, we'll give them 90 days. So they said 90 days from July 6th becomes October 4th. So if you let your policy lapse just one day, then we need an elevation certificate to reinstate that policy and have it rated at with that elevation data to get actuarial rates. So again, it's pre-firm properties in special flood hazard areas, and the policy lapsed and was reinstated on or after October 4th, 2012.
Is pre-firm all homes that were built prior to 1968 when flood came into
No,
existence?
every community joins the program at different dates because it's voluntary to join the NFIP, the program. What it is they call it a partnership with a community and the government saying we will allow flood insurance to be sold in your community if you adhere to basic floodplain management guidelines. And the number one guideline is they want that first livable floor at or above what they call a base flood elevation, where they think it's going to flood to. So I believe you joined, I believe you said 74? Yeah. So anything that was built prior to 74 would be considered pre-firm. Anything built after that or substantially improved, meaning it was cost 50% or more at the time of construction for improvement, that all of a sudden puts it as a post-firm building. And you would know that from whoever you get your building permit from. They would require certain requirements to adhere for floodplain management guidelines. So, new business on or after October 1st, 2013. So if somebody buys a policy or if somebody purchases a home, and it used to be called assuming the policy, can't do that. We have to have the elevation certificate to rate that building. Otherwise, they can get tentative rated policy. So it's a special flood hazard area. Thank you. Excuse me. So these properties, these buildings, we would have to have an elevation certificate rating. So that quote, grandfathering of pre-firm, when you to be able to assume somebody's policy for continuous coverage, they are no longer allowing that. Now also, as part of the bill, Congress mandated before that NFIP could only raise rates 10% every year. They have now changed that so they can actually go up to 20% on rate class. So they look at a rate class, and that's how they'll go in, and they can go up to 20%. But later on in the slides, I'll show you not everybody's going up 20%. So this is just this is post or buildings that were built before the community joined the flood program. Buildings built after, doesn't matter what flood zone you're in. This Congress says they can go up to 20%. So all flood zones and all pre-firm and post-firm, meaning they were built after the community joined the flood program. Now Congress thought, well, these rates are going to go up drastically, I'm sure, on some people. So their answer actually was to the affordability issue was installment payments. However, installment payments takes rulemaking, and rulemaking takes at least a couple of years. And I don't know how that helps affordability issue with installment payments, but we're not going to see that for at least another year or two. Then they also wanted NFIP to establish a reserve fund. When this bill was signed, NFIP was in $17.5 billion worth of debt, what they had borrowed from the U.S. Treasury. And when they borrow from the U.S. Treasury, they are required to pay that money back with interest. They have been paying a lot of it back after Katrina. This reserve fund, however, is not to pay the Treasury back. This is to be held separately for future flood losses. So this reserve fund, the Write Your Own company, or like Write Flood, any company that writes flood insurance for the U.S. government, for the NFIP, that we don't make any money on that money. You know, that is strictly every single penny goes into that reserve fund that is charged on somebody's policy. So they're starting out with 5% in October.
Starting.
So you'll see a separate fee for a reserve fund at 5% of the premium that you're being charged. So again, it's a separate cost It's calculated based on the total premium after your deductible, increased cost of ICC premium is what it's called, and CRS discount. But CRS discount stands for Community Rating Discount. And CRS is, you know, Billy, you said they have like a, I think it's about 15-20% discount.
We get 15%, Sullivan gets 20%.
Okay, 15%, 20%. So what it is the CRS discount is where community goes above and beyond just the basic floodplain management guidelines. In doing so, they're given certain points. And the more points they get, that helps the community prevent future flooding for their constituents. But it also turns around and says, okay, since you did so well, we're going to give that policyholder a discount on their premium. So your premium comes in and you automatically get, if you're on Sullivan Island, you get a 20% discount. It comes back because of what your community does. So the more you do, the better it is. The maximum discount is 45%. And I only know of 2 communities in the United States who have achieved that 45%. I'm sure it cannot be easy. But at least the community is doing a lot here to help that with the cost of flood insurance by having that CRS discount. A lot of communities in the United States don't even have it at all. Don't utilize that. So that's the reserve fund. Then we have what we call Section 207. This is where you hear all about it in the media. They're talking about map changes. So what the bill mandates FEMA to do is that they're saying to FEMA, or I should say the NFIP to be consistent, is that when there is a flood map change at the next renewal for an insured policy, they have to be rated at the new flood zone and or base flood elevation. So elevations can go up, they can go down. We've seen some of them come down just on a new map that was just done in Florida. But this is what we call the elimination of grandfathering. So say after Hugo, and I decide to build a house. And I go to my community building permit and get a building permit and say, okay, what do I have to do? And they say, well, you're in an A zone. So you have to build at, for example, 2 feet above ground level. I say, okay. And if you build it on a crawl space or have an enclosure, you have to have it properly vented. So I do exactly what the community tells me to do. Now, if there's a map change based on this Section 207, and all of a sudden I go from an A zone to a B zone, and the base flood elevation changes, they're saying at your next renewal, you're going to have to be rated in that B zone and that base flood elevation. And that's hard to swallow because you did everything you were supposed to do to be built in compliance with floodplain management guidelines. And that's what is really going up on the hill right now with senators. They're finally understanding, I hate to say this, finally understanding what they signed. Honestly.
Not the first time.
And, you know, it's sad because, you know, I do remember when this bill was signed, or right before it was signed, when it passed the House and Senate. And I remember from Louisiana, Mary Landrieu, Senator Landrieu, was screaming at them saying, you haven't given me time to sign this, to read this. But she just wanted that 5-year reauthorization that she signed the bill. And, you know, actually, you know, one of the writers of the bill, you know, Maxine Waters, you know, she's leading a charge to have FEMA stop this and to see if they can stop it. Unfortunately, FEMA can't. Congress can't. It's a law. FEMA has to enact this. So FEMA's been tirelessly working with Congress trying to see what they can do. But it actually has to be, a bill's got to pass the House, it's got to pass the Senate, and then it's got to be signed by the President. And we've seen numerous bills being passed by the House, but never making it to the Senate, or just the opposite. So, unfortunately, this is the one that's getting a lot of heat. And I think a lot of people, because I talk all over the country to insurance agents and the last few months going around talking about Biggert Waters to a lot of our agents and realtors and letting them know how this is going to impact people in that area. You know, I was talking in Kentucky and they're like, we don't have to worry about that. That's a coastal thing. That's Hurricane Sandy. It's only going to affect people with Katrina claims. Said no, it's going to affect everybody. And then their answer was, well, people who live on the coast are millionaires. They can afford it. And I said, well, I don't know about that because I know a lot of people who are not millionaires that live on the coast. And then I tried to explain, it affects you too in Kentucky. Because even though you might not be in a B zone, you have continuous flooding. So if your map changes, and then they got it, and then now everybody's just all of a sudden realizing this is not their issue, this is everybody's issue. And so that's why we're seeing more and more activity up on the Hill and talking about this. So this is supposed to happen probably next October, probably more so at my last meeting in DC last week. The head of FEMA, he had mentioned that they're actually looking at putting it off to January 15th, you know, seeing if they can move that. Because there's just so much activity going up on the Hill regarding this. There's a lot of other sections of the bill, but this really applies mostly to agents, you know. Multifamilies can get more coverage. They can get up to a $500,000 limit instead of $250,000 that a 1 to 4 family can get. However, it takes rulemaking, so therefore if that's postponed. Same with there's going to be new deductibles. Again, rulemaking. So that's at least a year or two away. There's some sections in this bill that does not affect FEMA. FEMA has no control of how to implement. This is all really with the regulators of lending institutions, federally backed lending institutions. Currently, you go and you get a mortgage, and they say, okay, you're in a special flood hazard area, meaning you're in an A or a B zone. If it's a federally backed mortgage, they are required to make sure you have a flood policy in place. So if they don't do that and their regulator comes in and sees this when they're doing an audit, they were fining them $350 per loan, up to a maximum of $100,000. So Congress said, well, obviously we realize after major flooding events, people who are supposed to have flood insurance still are not having flood insurance. So we're going to raise the mortgage, the lending institution's fine from $350 to $2,000 per loan with no cap. It can keep adding up and adding up. So now we've got mortgage companies very worried about this and really hitting and making sure each policy, each loan that they hand out that has a flood insurance policy going with that mortgage, and that they continue having that flood insurance policy. Another change they have to enact is, right now, under the old law, it says that if you have any part of your premium escrow, like your homeowner's escrow, you must also escrow your flood. Well, with this change, it says we don't care What if you don't have anything escrow? You must now escrow flood. So that's under the lending institutions. And they're also required to tell you that, is there anybody here that doesn't live in a flood zone? Everybody lives on high-risk areas.
Oh, yeah.
They all got it right.
Exactly, they're all trying, we all do.
Our mortgagee is going to be able to force place flood coverage, and is
Yes.
that market going to be available if what's happening to the federal market?
A lot of this is the mortgagees are going to have to force place.
And they're going to do it on a daily basis so they don't get a $2,000 fine.
Right, they're going to make sure, what they have to do with a force place policy is if you don't purchase a flood policy or you let your policy lapse, you don't pay the renewal, and the bank will all of a sudden send you a letter saying you have 45 days to purchase a flood policy. If you do not, we will purchase one for you. However, they don't have the rating criteria, and sometimes that premium can be very, very expensive. So that's forced placement. So, and then they also have to tell you, even if you don't live, quote, in a high-risk area, flood insurance is available, and you don't have to buy an NFIP policy, even if you're in a special flood hazard area. You can go out to the private market. I don't know many private markets that write a lot of A and B zones. And unfortunately, like with our force place policy, this is just my opinion, my concern, is that if it's a private carrier doing the force placement and they realize, wait a second, I'm getting the higher risk, I'm getting the older buildings, we're going to start seeing their rates skyrocket up. I know one person in New Orleans, and this was just 6 months ago, her bank forced placed a policy on her, it was $50,000 a year. So, but that was a private carrier. NFIP does have forced placement, but it doesn't go up to high, I don't think. So, but that's through a private carrier. So they're very strict in making sure there's some kind of flood coverage on there if there is a loan. There's many other sections of the bill. You know, they're really looking at remapping and the accuracy of this remapping, because it really is affecting so many people, and being able to appeal that. You know now that anytime there's a mapping change, they have a preliminary map that comes out first for 90 days. And you have every right to look at that map. They usually have it hanging somewhere. And if you don't like what's on there, and you have scientific data to prove that that's not the right flood zone, they will look at it, and it's called the appeals process before a map is issued. But they really want to get more involvement and the technology that's out there. Maybe there's something better for better mapping. So also, they want to take a look at the affordability of pre-firm homes. That's a study they're going to be doing. And then they also are really pushing for privatization of the flood program. As the flood program started in 1968, the government didn't come into this program thinking they were going to be here this long. They thought they were going to create this program and private carriers were going to jump on board and say, wow, this is great, we want to do this. And also, you've got to remember that it's called the National Flood Insurance Program. When it was established, it was never the intent of the program to make you whole, as in normal insurance. It was only to help you get back into your home. And so, and we can see that with that cap of the $250,000 for broken coverage. So they're really looking into other ways of privatization, maybe getting reinsurance, you know, to help, and really trying to get private carriers to look at this. But just last week, they were saying, you know, it's probably going to take 10 years before there's a real solid market out there that's going to take a lot of these higher risk flood zone properties. So a lot of questions we get asked is, what if my policy says, and I get that letter saying I'm getting a 25% increase because my flood policy is based on it not being my primary residence. But it is. Just let your agent, insurance agent know who wrote the policy, or there's a form that you can sign and say this is my primary residence. And we can correct that bill and refund the difference. Our non-primary homes and non-residential buildings rated in, these are what are called minimal or low risk areas, BC or X zones. Are they subject to that 25% increase? And the answer is no, because those are considered actuarially rated already, your BC and X zone. Those are your non-special flood hazard areas. The insured is being rated pre-firm but has an old elevation certificate. Does the insured have to get a new one? And the answer is not necessarily. If the insured has an existing elevation certificate and there's not been substantial improvements, it hasn't changed the design, they haven't torn down the old house and rebuilt the new house, and that elevation information's on there for rating, which is our base flood, our flood zone base flood, the lowest floor elevation. If you have an enclosure, the size of the enclosure, and if it's properly vented. We're looking at that in B zones, we're looking to make sure it has breakaway walls. So that's what we're looking for. How is the building elevated if it is elevated? Is it on piers, posts, or pilings? Or is it on a crawl space or foundation walls? So it provides the information we need. We can use the old elevation certificate and just use and we just have to get recent photos for that. What if a pre-firm rated policy lapses as the mortgagee check was not received? So say they have their flood insurance escrowed through the bank, and the bank inadvertently forgot to pay the renewal. And as you know, with flood insurance, you have your expiration date, but you have a 30-day grace period to pay it. If they pay it 1 day late after that grace period, there's no exception. To reinstate that policy, you have to have an elevation certificate. So if you have your flood policy escrowed, check on it, make sure they're paying that renewal, especially if you're a pre-firm property. The only exception to the rule is if a community is suspended from the NFIP and later reinstated. Then the subsidized rate can be used if we receive the application and premium within 180 days from the date the community is reinstated. What if a pre-firm policy is assigned to an estate or trust? That is not considered a new purchase. They haven't purchased that building, they haven't purchased that home. So if it's taking a name change, like you're taking, you've got married and you want to add, your spouse on there, or if you want to put it into a trust, that's not considered a sale. So therefore, that would not need to have an elevation certificate to do so. What happens if the insured can't get an elevation certificate before the renewal? Then the agent would have to submit an application and payment based on tentative rates. And we already talked about the tentative rates. And what happens at claim time. And again, when you see WYO, that stands for Write Your Own Company. That means the company writes for the National Flood Insurance Program. NFIP sets the rules and the rates. We just administer it for them. So when you see that WYO, that's what that means. So all rates increase to 20% due to the annual pre-firm rate increases went from 10 to 20%. And no, NFI figures out it's an average of about 10% across the board. But as you can see, if you're a pre-firm property in an A or a B zone, you'll see your premium increase 16 to 17%. And it's not like, okay, I'm paying 1,000 now, it's gonna, I'll just multiply it by 17%. And I apologize, the actuary at FEMA has tried to explain how they do rates to me over and over again. It just doesn't get through my head. Because right now there's two separate rates on your policy. You have a basic and additional. The first $60,000 of premium is based on one rate, say like $1 per hundred. Any additional over that, up to $190,000, is based on a different rate, more like 8 cents, drastically down. So some people will see, she said my rates were going to go up 17%, and I'm only seeing a 15%. Or she told me my rates were only going up 17%, why does it show 18%? So it's flexible in that way. It's a rate category is how they do it.
Patty, before you get off this chart, does that include the 5% reserve?
No.
So is another 5% on top of those rates?
Yes.
For everybody?
For everyone. For everyone. As you can see, post-firm, their rates too are actually increasing. You'll see at the bottom what's called a PRP policy. That's your B, C, and F zones. And you can see they're going up less than 1%. The extension is a whole other game, but fortunately you don't have to worry about, so I'm not going to try to confuse you with that one. Will there be any other changes effective October 1st that are not part of Biggert Waters Flood Insurance Reform Act? And of course, NFIP updates their manual twice a year. Every October, rates increase. And then we get updated community information, like the community rating system information, to see if any of those percentages have changed. And they also, in May, update those community information for us. So typically we see changes in our manual twice a year. But this October, we're also going to see there's a federal policy fee that you all pay on your policy. That's going up as well. Currently, you pay $40 a year for the federal policy fee. That's going up to $44. Again, agents don't make any money off of that. That's really to run the flood program. Lender required. If any of you have gotten that forced-payment letter saying you have 45 days to purchase a flood policy, you used to be able to waive the 30-day wait, much like a loan closing. However, they're no longer allowing that. So even if it's lender required, it has a 30-day wait before the effective date. And for agents, they're going to be asking more questions about the building for rating purposes, to make sure they're rated correctly. So does the lender require 30-day waiting period apply to loan closings? The answer is no. Loan closing is the only one that can waive that 30-day wait, as long as the policy and the application are dated at or before closing. So they can waive a 30-day wait and have it effective the date of the loan closing to comply with the mortgage requirements. And our policy is no longer allowed to be assigned. There's no point to assigning a policy anymore if it's pre-firm. You would have to get an elevation certificate. You can't grandfather. You can't have continuous coverage when you buy somebody else's property. So technically, that is going away. There's no advantage to that for a pre-firm building and a special flood hazard area. And what would the premium be if a new map changes the flood zone from an AE to a BE, pre or post firm? And again, that's section 207. That's next year. I don't know. I'll tell you, with these pre-firms, it can get very expensive in selling existing properties or purchasing a property and trying to figure out what's the flood going to cost? How much is it going to cost me? And that's the big thing which I was talking about the realtors this morning. And I'm leaving for Orlando tomorrow to speak to the Florida Realtors Association. We have a big expo going on to talk about this as well. So the key here is a lot of people just want to know how much is it going to cost me? And everybody might be just a little bit different based on buildings. So we really don't have like an exact, we can give you an approximate. Unfortunately, I gave one this morning. And I might want to run out the back room and give this one. But somebody asked me this morning that there's a house that's pre-firm. And it was built in, we believe he said the 60s, 1960s. It's elevated on a crawl space. A small crawl space. It was built that way. Now that the person never had flood coverage, they're selling their home, the new people want to know how much this is going to cost. Well, since you can't grandfather, there's no flood policy, I'm looking at it, I said, so what's the flood zone now? Is it still an AE? He said, no, it's a VE. I said, do you have any idea, you know, what the elevation, like is it 3 feet below what they consider the base flood? Is it 6 feet below? Is it 8 feet below? Because I had an example for 8 feet below, and he said, yes, actually, it's probably at least 8 feet below. Well, if it's in a V zone, and it's 8 feet below base flood, and it's not elevated on highlands, just for building coverage maximum, $250,000 a year. It's around $65,000. And that's the maximum that FEMA is allowed to charge. So you can see, this really is, you know, and I don't think they realize the impact. They're thinking, oh, it's going to cost them another couple $1,000s. When in fact, it can really affect somebody's premium. In fact, trying to sell a pre-firm building. Right.
The market February and I had five parties. Dying to bet I'm going to raise my children here and I'm going to raise my grandchildren. Gone. I've now had to reduce the house $80,000. And I haven't sold it.
Right. Right.
What is this going to do to the market?
Exactly, and that's why in speaking with realtors and getting this message up on the hill, you know, unfortunately they're so focused on the map changes and post-firm buildings, and they assume there's just so little pre-firm buildings. There's not that many. Everybody rebuilds. You know, there's a lot of areas. I mean, I was telling Billy earlier. When my husband and I moved to Arizona, they asked me if I wanted a new or a used house. I never heard a house called used before. And I looked at them, I'm like, a used what? Of course, everybody wants an older house. I mean, the character, you know, it's like, I'm thinking, and they're looking at me, you want used? And, you know, the turnout, a lot of people just think there's not that many. It's not going to affect so many people. But if you look at it, like with Katrina, and they talked about how many people didn't have a flood policy, those homes were passed down generation after generation. There was no mortgage. They weren't required to buy flood insurance. So that's why that scales off, you know? And look at Charleston, look at historical areas and how it's going to affect that. So there's so much that I really don't know if they knew these implications when they put this bill forward. And this is where, you know, sure, I probably should be filmed for this. But there is an agent in New Jersey who has a sign on his front lawn, huge sign. It says, "Don't blame FEMA. Don't blame the insurance company. Don't blame me. Call your congressman." You want change, and that's what it has to go through. And unfortunately, I got a copy today of a letter signed by David Miller, who's the head of NFIP, sending a letter to the Honorable Maxine Waters, because she sent a letter demanding that FEMA do something about the affordability issue. And he wrote back very nicely, but in the end said, "I can't. I have to follow the law. If the law changes, we can do something." So that's where, and I don't think people are really going to hear this until October renewals start happening. And homes, they can't sell their home. You know, and this is what, you know, just trying to get this message out to let everybody know. This is not just a coastal issue. This is not just a Hurricane Sandy or a Katrina issue. This is everybody's issue. Everybody needs to understand how this can impact everybody.
Let me just interject. We did some work. Douglas is here. He had some data based on our CRS rating system. The supplier provided us information. We probably have 30%, maybe more, of the properties on the Isle of Palms that either do not have, are pre-firm or are below the base flood elevation. And they're going to be whacked, you know, starting immediately or as soon as they sell their property.
You've got numbers.
It's not their primary home. Look at that. They sell their primary home. They don't want to sell it. You know, they'll just have a normal rate increase as everybody else, you know. But if it's not their primary residence, which you got to realize, this is a vacation area. A lot of them aren't. Primary. Yes.
Even if it's pre-firm flood or base plane or something like that, what is that along the coast here where we have hurricanes and you don't never know how high tides go there?
Right. You know, when they do that mapping and they determine a base flood elevation, I've had mappers try to explain this to me, where they look at the topographical information, they look at prior flooding history. So they're not going to base a base flood elevation just because of Hurricane Hugo or just because of Sandy. And say, okay, that might be a 1 in a 200-year storm. You might flood, and that, you know, but you're probably not going to flood every time at that same height. So they kind of calculate that into determining that where they think it's going to flood to. Can always flood higher, might not flood as high.
Now, the grandfathering, I mean, the mapping change is, of course, just a loaded gun, and we don't know when it's going to fire. So when they issue the new maps, and we don't have any scientific data, so I assume we can't protest it, a good number of the existing elevations can change. We could move from one zone to another. You could be an AE 14 and go to...
Let me give you an example. When Katrina hit, they were in the process of updating their maps. They just finalized the maps this year. Just going back and forth and, you know, levy issues and this and that. So it's, you know, they have these ideas of, you know, remapping. Fortunately, you were just remapped in 2006. I haven't seen any schedule saying you're up for a new map, rate map. And they did require, Congress required that FEMA update all the maps back to 2005. They said, you've got to go out there, you've got maps that are 20 years old. You've got to update your maps. So that's what they did for 6 years, is to go out these highly populated areas and do remapping. So I can't tell you when or even project when another map might come up.
I'm looking at Douglas over there. Aren't we being remapped now?
That's the word we've got.
Really?
There are preliminary maps waiting to be distributed. But heard that 6 months ago, we called the subcontractor that was preparing the maps. They're not ready yet, but we've been told that they're in the works.
So will they have to be redone?
If they're looking at remapping and looking at it, yeah, they'd be coming in and looking at the preliminary but, you know, part of the bill also talks about making sure the data being used for the remapping, getting more of a community involvement in the remapping, so those maps are more accurate. Because with this change here, I'm seeing all these scheduled maps updates, like in Florida right now, they've got quite a few of them that are in the preliminary stage. It's being postponed and postponed and put off because, you know, somebody else says, well, I've got this data, or I don't, this isn't right. And the most bizarre thing I saw was in New Jersey, Long Beach Island. It's a coastal barrier island. Got hit by Sandy. They're doing the remapping. They did the preliminary maps. And I'm looking at the preliminary maps, and all the houses that sit right on the ocean front are now not in a flood zone. Everybody behind them is in an A zone. And if you're on the bay side, you're in a B zone. And I'm looking at this map saying,
Something wrong with
what is this? This is crazy. So now they're fighting all of this, and, you know, and it's like, I couldn't even begin to tell you how they.
But is that because they built some sand dunes 20 feet on the ocean side?
I can't tell you because all those people had flood losses. And
Okay.
so turn around and say, all of a sudden, you know, you're not in a high-risk area and you're oceanfront. Yes.
Patty, on your schedule, just a question about the categories so I can understand.
Sure.
You've got the single-family non-primary residence, I understand that, but I'm not quite sure the rationale. 2 to 4 families and other residential, meaning larger facilities with multiple units?
Right.
And what is RCBAP? What does that category include?
That's, RCBAP stands for Residential Condominium Building Association Policy. There's three flood policies. There is the dwelling form, which is for 1 to 4 family. Then there is the general property form, which is for anything over 4 units. And then there's, that would be like apartments. And then if the building is in form of a condominium association, meaning 75% residential, there's the Residential Condominium Building Association policy.
So my question is, that category seems to be getting a preferred rate
Right.
over a single-family non-primary residence?
They're not affected by that 25% increase. It's only single-family, non-primary, and non-residential. So if it's a duplex, if it's a condo association, if it's an apartment building, they're not being subject yet that 25% increase. Because the bill only states single-family, non-primary, and business properties or non-residential properties. But they will get it if they sell that property. That's only applied to that 25% increase every year. However, if they sell their property, they automatically have to get an elevation certificate, whether it's your primary or not, no matter how many units are in the building, no matter if it's a condominium association or non-residential building. But that's how the bill reads.
Just to be clear on your answer to that question,
Yes.
the 2 to 4 family, other residential, if those are units that are used as non-primary residence
Right.
units,
Exactly.
how are
Very
they,
good
are they
point.
treated, they're still treated better than the single-family non-primary?
If the condominium association buys the flood policy, right, it's issued under a condominium association policy. But say I, the unit owner, decide, you know, I'm on the first floor, the association doesn't have a flood policy, so I'm going to purchase one myself for my unit. And when we rate that, we have to rate that as a, quote, single family, even though it's in a multifamily building. And if it's not their primary residence and pre-firmed in a special flood hazard area, you're absolutely right. They would be subject to that 25% increase.
But if the regime is buying a policy for the whole business, then
Then
whether or not it's primary is irrelevant.
Then they're not charged at 25%. And I know there's a question here, so.
This is really for the council and office staff. Do you have the present maps available, and can we come and see where our properties are on those maps?
Douglas has them on the wall.
Will we be notified when the new maps are available?
Certainly.
All residents?
We'll put it up on whatever communication we can find. We'll put it up as soon as Douglas gets them, but do we have to sign for receipt? Can we deny receipt?
Yeah, you have to sign and state you'll adopt the maps, the new maps. And the reason why they have that in there, that if, if you have a lapse in coverage because the community is suspended, and then they're reinstated, this is what happens all the time, is the community will get the maps and then they don't sign them. And they don't adopt, they're not signing off on them. And so the date that new map's supposed to be effective, their community is suspended from the flood program. So then the next day they sign it and send it in and then they're reinstated again. So that's why they have to put that in there that way. So I asked about that.
Somebody mentioned earlier a comment you made this morning with the realtors dealing with improvements to properties that don't have a pre-firm. In that we work with the 50% rule right now.
Right.
And that's changing? That was the implication.
What makes flood so confusing, another thing I should say, is NFIP relies on the community official who gives out building permits, fixing the home, to let them know it's based on how you determine that market value. And at the time that you get that plan that says, okay, I want to add an addition on, or I'm going to redo my kitchen, or I'm going to do that, and they determine whether that project is going to be 50% or more of the market value that the community says it is, whether they have to adhere to the floodplain management guidelines when doing those.
Okay, what I thought I heard was that 50% rule was going to change to a 30%.
Oh, yeah, that's in the bill. They're not enacting that right now also.
But it's in the bill.
It's in the bill.
Yeah.
It's in the bill.
So they will enact it at some future date, or?
There's so much, that's another point of contention up on the Hill, where they brought that up as well. So I'm not, it's in there. They have 5 years to enact everything. And if you want to type Biggert Waters flood insurance reform, and you can get a copy of the bill. It's a few hundred pages, and going, 100-something pages, I should say. I think it's 150 pages. And go through each and every one of the sections of the bill. It's quite large.
But the bill doesn't have any type of trigger for when remapping will occur. Right. That's the biggest thing. It's just...
No, the way they're looking at it is what they take the sections FEMA's responsible for, but the reason they started right away with the non-primary residents is the last time the flood program before July 6, 2012, when it lapsed right before that, they reinstated it for 30 days, and that was the only section of the bill. That other bill is called HR 48 something, 57, I believe, and that only said if it's single family and not the primary, it's not the principal residence of the named insured, they get a 25% increase annually. That was part of that bill. So they incorporated that into section 207, but they were just told to, if you read the bill, they're supposed to enact The map change, section 207, effective, everything was supposed to become effective July 6, 2012. So, kind of phase it in, and there's more questions up there than answers.
I think we're winding down. I do want to make sure Sandy communicates one thing that he told me earlier, and that had to do with excess flood insurance. He had some data where the excess flood insurance premium is going up excessively also.
I have a case where an individual has a property and the home has a loan on it of $500,000. The first $250,000 is covered by NFIP. The second $250,000 is covered by the surplus line that this individual's insurance broker was able to realize. The surplus line had been $1,300 and change. The home has been re-rated, and I'm not aware of how that has happened, from an A7 to a B zone. It is on the water in Charleston Harbor. Its premium has gone up to almost $16,000 on that surplus line. Now, the point I want to bring out is that they're shopping that surplus line, and there are some lesser policies out there, but none of them near the $1,300 that they realized for many years on that. It's not a direct result of the Biggert Waters Act because it isn't NFIP. It's an indirect, unintended consequence, I would challenge, though, of this ruling. And I have pushed it forward to Senator Scott's office and several of the congressmen from our area to be sure that they understand, and Congress does that. Part of the Biggert Waters Act, though, there was to have been a FEMA study of the economic impacts that I've not been able to get my hands on, and I've been told because the speed at which this bill moved through the Congress and the Senate and ultimately the President signing didn't allow for that study that I understand is mandated. And that's what everybody is sort of asking for on the Hill is, whoa, let's slow this bill down just a moment, pull it back, and not enact it until we get the economic impact of it. And this is part of that, among how it's going to affect the 30-some% of our community here. It's going to be a big, big impact.
I can say, like, for the excess lines, many of them are different, the surplus companies, but that building was probably built in compliance with floodplain management at an AE zone.
It's 16.7 feet. It's supposed to be at 17 feet, so it's 3/10 of a foot below the required, and they're, being penalized.
Well, a lot of some excess writers really are afraid to write in B zones, and some won't write in B zones. So if the policy was issued initially in an A zone and they realized the map changed and they're just realizing it, that might be another reason why that rate went up so drastically. Sure. But I've seen where people are sending in things, the surplus lines are not taking flood insurance anymore, with a lot of non-residential DIC policies cover flood. Now they're excluding flood completely.
Well, thank you for your time. I don't think we want to hold you here all night. Patty, I don't know how you keep it all straight. And Bill, go ahead.
Lost my dinner appetite.
Yeah. All right, you got our attention, Bill.
All right, if y'all don't mind, from the agent standpoint, a couple of things. If you have a pre-firm home and you do not have an elevation certificate, check with your neighbors. If you're this high off the ground and you're pre-firm and your neighbors are this high off the ground, you probably should get an elevation certificate now, because if all of these other homes are going to have to get elevation certificates, supply and demand, there are only so many surveys, and you get backed up and then you're, so I would suggest getting it sooner, and then you can talk to your agent and say, hey, is this going to save me money over this 25% increase, so I need to pay for it. So, first,
How do you get the?
survey. Contact the surveyor. Any surveyor should be able to do an elevation certificate. If you can't find one, call the office, and we've got surveyors we know that are happy to do elevation certificates. I think it was on Alabama. Okay, so, second thing, if you have a mortgage on your home, we see this more often than I like. Mortgage is sold. The agent's not notified. So we don't change the mortgage on your policy. The renewal doesn't get paid. We didn't know that. So check your mortgage. If it's been sold, make sure you let your insurance agent know what it is so they can change it on all your policies. Just don't assume it automatically happens. And then if you have a home that, let's say, was elevated high enough where you can, say, walk underneath it or something, and after you may have bought the home, you happen to do a little enclosure underneath there because you thought it would be kind of neat to store some stuff or have a man room or something, be careful. That I know Mount Pleasant's cracking down on that, and we've actually had clients call and say, I'm looking to sell my home. I may or may not have done something like this. What should I do? Get it torn out quick. Thank you.
Thank you. Very good.
We're not sharp guys.